Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, Ryan Bolton here. I am a mortgage nerd. This is the Clear to Close podcast, and today we have a very special guest with us. He is a reverse mortgage specialist. This is Trevor Carlson with Heritage Home Loans. Is it Heritage Home Loans or Heritage Mortgage?
Both.
Okay, Heritage Home Loans. So I've known Trevor for years, and people will ask me about reverse mortgages all the time, and I know a lot about them, but a lot of times I will just say, I got a guy for you, and he's my guy. And people even say, who will you send your grandmother to? And I said, this guy. So if you need a reverse mortgage in Southern Utah, this is your guy. So I wanted to bring him on to talk about a little bit about that. So first, introduce yourself, kind of give a little history of how long you've been in the mortgage industry and let everybody know who they're talking about.
Yeah, sure. So I'm excited to be here with you and talk about this. Obviously, I'm passionate about mortgages and reverse mortgages in particular. I've been in the industry. I joined in the fall of 2006, just as we were about to go off the cliff of the Great Recession. Right. And for the first 10 years of my career, I was a normal loan officer, did regular mortgages, VA, all that kind of stuff. And around 2016, 2015, that's where I discovered reverse mortgages and saw that, man, this product really makes a difference in the lives of the people that I'm serving. And so it was around that time that I decided it was time, started my own company, and we just jumped all the way in. And so since then, really, reverse mortgages is all we do. We just try to be really good at it, try to deliver a superior experience. And then, like you say, we try to serve the industry so that the other side of the industry can focus on what you do. So.
Right. Well, and I found that it is one of those products like construction loans. You really got to be doing that all the time. It's really tough, I think, to do forwards, which is just normal mortgage, and reverse. So how does a reverse get its name? I mean, when I have people to call me, some of the most common questions I have is, well, how do they make any money on this thing? And then they learn that the balance actually goes up, and then they kind of get a little bit scared with that. So kind of, is that really what kind of where the name came from, is just how the loan works?
Yeah, so I mean, the basic history of the loan is it goes back to the late 80s. President Reagan was president when it was instituted as a law. And the idea is we need to do something to help this segment of people in our economy or in our nation that are house rich, cash poor. You know, they're retirees, they have no income, but they have their home paid off. So how do we help them? And so the loan was designed to allow people to use the equity in their home to supplement their retirement. Now, the issue is that over the first couple of decades, the loan was poorly designed. And so it really hasn't been until about the last 10 years, 8 to 10 years, that the new reverse mortgage has become a life changer for people. And most of the people I talk to, they overcomplicate it. And so, you know, whether it's other professionals or our consumers or our clients, the easiest way I've found to explain what a reverse mortgage is to compare it with a regular mortgage, because mechanically they're exactly the same.
Very much, yeah.
The idea is that you're borrowing money from a bank, and the bank's going to charge you interest on how much money you borrow. The number one difference is that with a regular mortgage, of course, you have that monthly payment to pay the interest and pay the principal, so you'll slowly pay the loan off over time. The only difference with the reverse mortgage is that payments become optional. You can make payments if you want to, and it'll do exactly the same thing. But for most people, that's the key feature, is that I can live in this home for the rest of my life as long as I pay property taxes and insurance. As long as I or my spouse live there, we can stay until age 150, and that interest will be added to the loan. So your loan balance will slowly trickle up, as you mentioned, and the bank gets paid when either the homeowner sells the home and pays off the mortgage, or they pass away, and the kids step in, they inherit the home, they sell the home, and they keep whatever equity's left over.
And I think that's probably the next biggest question I get, because I'll have either family members, the kids, wondering, okay, what's going to happen with this loan? Does the bank just get the property after they pass away, or move into assisted living or hospice or whatever type of care at that stage? Or if just dad passes away and the mom's still alive, what happens? So I'd say that's probably the next most hurdle you probably get, is what happens when the spouses, the parents, both pass away or move into assisted living. What happens to that loan and that property in that case?
Yeah, so again, the easiest way to explain this is to keep it simple. It is exactly the same as any other mortgage. If somebody has a mortgage today and they pass away, the family inherits the home. They can't keep that mortgage though, right? They have to refinance, or they have to sell the home to pay off the parent's mortgage. And a reverse mortgage is exactly the same. And so the home always belongs to the homeowner, or by association, it is transferred as an estate to the family. And so again, this is one of those misconceptions because with the old reverse mortgage, it was designed with the bank in mind. The mortgage balances were too high, the loans would grow too fast. And so the vast majority of them ended up going upside down, where the mortgage would exceed the value of the home. And this was bad for the banks, it was bad for the homeowners, it was bad for the family. The new reverse mortgage changes all of that. The loan is designed now so that the mortgage typically will grow at or slower than normal appreciation. And so the amount of equity the homeowner has in the home today typically will be roughly the same, if not more, 20 years from now.
And they've really lowered or changed how much you can even finance. It's not like you're financing 100% or even 80% or even 50% in some cases. I mean, the loan to value is pretty low. So if it were to exceed, so let's get to the point where the housing crisis, or even in 08, we didn't see a lot of foreclosures in reverse mortgages. But let's say it does get to the point where there is more owed than what's actually you can sell the property for. What would happen then? Does the bank go after the estate or go after the kids, or what happens then?
That's a great question, and it's funny, as I've played with the tables and the projections and those kind of things in a pretty conservative future projection, you would have to live to be 130-ish for the home to go upside down in a normal situation. Right. But again, if the market does crash, it affects all of us. It doesn't matter what kind of mortgage you have. But in that situation, if that happens and the home goes upside down, again, it doesn't matter. It doesn't affect this homeowner because the loan is guaranteed by FHA. So they can stay in the home again until they pass away, turn 150, or until both of them have moved out of the house. And so the family's never responsible. If that were to happen and the mortgage does go upside down and there's a loss for the bank, that's when FHA steps in. The family never has to step up and pay that money back. They're never responsible for any of those losses.
So what is the benefit to a lender? It seems like originally there was a lot of benefit to the lender side. Is it just because it's a very low risk loan? It's insured. I mean, is that kind of the reason why lenders even want to loan on this type of thing? Because they're basically loaning the $200,000 now, whether it's a purchase or a refinance, but they're not getting really paid for how many years down the road before they even get paid. Right. So is that just really kind of their benefit? Is it just kind of a low-risk investment is what they're looking at?
Yes. There's a couple of things there because, as you mentioned, if we eliminate a homeowner's mortgage payment, of course, that makes them financially more solvent, right? They have more ability to deal with life and inflation and those kind of things. But likewise, because the loan is guaranteed by FHA is covering the risk. And so, yes, the bank may have to wait 10, 20, 30 years for the mortgage to be paid off, but they know every one of them will be paid off. And it
is accruing interest. It's not like it's a non-interest bearing account, so it will slowly go up over time. But I think that's the important thing to remember is you can make a payment if you want. So it is something where if that's really a big concern. But a lot of times I see so many people that could really benefit from this type of loan. Like you said, they can't qualify for a traditional loan. They don't want a monthly payment necessarily or not an increase in the monthly payment. So getting access to all this equity is usually a better and still leave money left over. Very rarely do you see these things really go upside down. So the kids still get an inheritance, but mom and dad get to live in the same house. They get to stay in the same home. If they are able to eliminate that $1,500 payment, that $2,000 payment, whatever it might be, now what else can they do with that money? Maybe they can go on some trips or get some health care they need. I had a great story of a client that did a reverse mortgage that was handicapped that needed some money just to make the stairs go away, make a ramp and make it safer in the home. And it was a life changer, like you said, for her, because she thought she was either just going to lose the house or lose it to foreclosure. We were able to keep her in the home that actually she was more comfortable with. Yeah. And she spent way more time more comfortably in that home than having to move, relocate, find a rental, all those things. So I think where it fits. So where do you think it doesn't fit? Like if you run across a client that maybe they're just trying to buy too much of a new home and the tax and insurance are way too high. There's still expenses with the home. Where do you see it's not quite the best fit when somebody looks at a reverse mortgage?
So my number one recommendation here is that it has to be a long-term solution for you. If you're going to be in this home for at least 5 years or more, great. Beyond that, typically it's better to stick with a regular mortgage, a 30-year fixed mortgage, keep paying that balance down. Use this as your permanent solution. If this is going to be the home you're going to stay in for the rest of your life, is ideal.
So you just see people like transition from employment to retirement. This is kind of that key piece that being able to say, well, okay, we didn't get the house all the way paid off, but we got all this equity. Let's tap into that in a better way.
Well, and so there's a couple of features there that I do want to touch on because it's really what makes this loan more of a financial planning tool than a mortgage. And so your example reminds me of one of my clients recently, where her husband's gone into a care facility, and it is probably below average here in town. It's not one of the best ones. It's not one of the worst ones, but it's not great. And she's $5,000 or $6,000 a month. And I should have brought the statistics, but essentially what we're told is that roughly 70% of baby boomers will need long-term care, and only 3% of them actually have long-term care insurance.
Wow.
And so when you're talking about that kind of an expense, not having that insurance could put anybody into bankruptcy. And so that's one of the benefits of the loan, is that eliminate your mortgage payment, buy that insurance that you need, and make sure that you're both protected for life. The other key feature that I do want to talk about is the growth line of credit. Because again, this is one of the key features of our loan, is that in the situation you're talking about, let's say we do a reverse mortgage, we pay off your existing mortgage, and now you have no payments. That's great. But let's imagine you have equity left over that we didn't need. And so let's say $100,000 is left over. That money can go into a line of credit. But the beauty of that line of credit is that it will grow by the interest rate on the mortgage. And so right now with 7% interest rates, that $100,000 line of credit is going to grow automatically by 7%. And I have a lot of clients that will look at that and say, man, this is awesome. I'm getting 1% in my savings account, 3% on my CD, 4% in my money market. On my mortgage, I'm getting 7%, and it's non-taxable. And so they'll take a big chunk of that money out of the bank. They pay down their mortgage balance, so they're being charged less interest on their mortgage, but they're also getting that higher return on the money that's available to them in their line of credit. So again, it's just a much more robust or savvy place to put your money when you don't need it.
I think it's real important to have these conversations, whether you're the trustee of your parents' trust or you're trying to kind of talk about some of these financial options and not be totally scared away from a reverse mortgage. Because either there is preconceptions from the older generation, and there's even preconceptions of the younger generation that will be taking over for their parents and their estate. Yeah. But I think so many times it's better to keep them in the home. I have seen times where maybe they upgrade or buy a home with a reverse mortgage that may be a little more and they end up having to downgrade it.
Right.
But I think that's a key factor. Let's say it's been a few years since you've done the reverse mortgage and the car goes out, or the transmission or medical expenses or something pops up, knowing that you can tie back into that to have that be a savings account or a way to be able to tie into that, versus having to do a whole nother loan. I often tell people you can't get to your equity without selling or refinancing. This is one of the better ways of getting to that equity while still being able to stay in the home without increasing your debt load. If anything, you get rid of all the other debts. So really you can live out those golden years much, much more comfortably and buy the things you actually need, like the insurances or retrofitting the house or doing the remodeling to keep you in the home longer than it is to force you to have to sell it because you can't debt service that payment anymore.
Right.
And you see that happen a lot where you have maybe a husband and wife and the husband passes away and the spouse doesn't know what to do.
Right.
She hasn't worked forever. She's been a homemaker forever. She has no income. Maybe Social Security goes down or changes with that death, but they got all this equity they can't get to without selling or refinancing. So I think it's really important to have a conversation with everybody involved when it comes to a reverse mortgage.
Well, I mean, the gambit of how people are using this loan is completely open because, I mean, we have clients that are multi-millionaires, and they love the idea of having their money tax-free to spend it on whatever they want, right?
Right.
We have clients that we save from bankruptcy on a regular basis because they just can't afford to live with inflation and everything. The vast majority of our clients are somewhere in the middle. They just want to live better. They want to travel. They want to see their kids. And having access to that money allows them to do that kind of stuff. It makes life better for them now. And guess what? The kids will still inherit hundreds of thousands of dollars when they pass away.
And I think that's probably the number one question I have from the kids' side of things is, okay, my parents had a reverse mortgage. Does the bank just get the property back? I'm amazed at how often that is thought of when it's like, okay, what if it was a regular loan? What would happen? It's like it switches in their head, well, you just pay off the loan.
Right.
Same thing with reverse. You just they're not changing ownership. They're not owning it. In fact, I've had this conversation with a guy on Facebook that, hey, you're just renting your house from the bank. I said, no, it's the collateral for the loan. They can't just show up one weekend and say, hey, this is our kitchen. We're going to make some top ramen or something. We're going to make some food in your kitchen. No, you own it. It's just the collateral used for the loan. And this loan just works reverse in the sense where the balance goes up instead of down without payments. But interest is going to accrue on any loan anyway.
Every loan.
It's just how you pay it is different with a reverse mortgage. And, of course, you have to be 62 or older. Now, I know recently, and this may not be as recently, they changed it to where only one of the people have to be 62. So kind of explain that. If you've got a spouse that's under it, can you do a reverse mortgage?
Yeah, so that's excellent. And that, again, was one of the major changes they had to make to fix the new loan versus the old one. Because in the old days, to be on the mortgage, you both had to be 62. And so if he was 62 and she was 61, they did the mortgage with just him on there. The problem is that fast forward 25 years, statistically, he's going to die first, right? and all of the equity's gone because, again, that old loan had loan amounts that were too high and it grew too fast. And so imagine the nightmare of that situation. He passes away. She's not on the mortgage. Essentially, she's being kicked to the curb. That's what happened on the old mortgage. And fortunately, FHA stepped in, grandfathered in all of those old loans. So if this happens to somebody, we can take care of them. We can make sure they get to stay in the home. But in the old days, that was one of the myths and nightmare stories that you'd hear, is that grandpa died and grandma got kicked out. You know what I mean? Because it looked like that's what was happening, when unfortunately there's more to it, why that was such an issue. But again, not something we have to worry about anymore.
So, and how much younger? If it's 62 and you've got somebody 45, more power to you, buddy.
Yeah,
but
so the spouse has to be at least 18, and
at least 18. So even
18.
just enough to sign the contract. So there's no age cap as long as someone is at least 62. Yep. Now I understand that as you're older, you get a bigger percentage or more of the loan to work with. Is there tiers with the younger person being under 62? I mean, how does that tier as far as how much? Is there kind of a minimum LTV and then kind of a maximum? Kind of explain kind of how much could be freed up. So if somebody's listening to this podcast with their parents, say, well, I owe $100,000, but it's worth $5,000. Roughly how much could I get access to on top of just eliminating the debt? And real quickly as well, I've had people think, well, I have to be free and clear. That property has to be free and clear, and it really doesn't. So kind of explain how much money would get freed up as a percentage of the sales price or the appraisal.
So again, to that point, I mean, that's a really good point. I'll just quickly answer that. This loan is used for people who own their home free and clear, people who have a mortgage, who need to pay it off and eliminate that mortgage payment, or people that want to buy a new home and not have a mortgage payment. And so really it's the people that have a payment that benefit the most from it. But yes, to answer your question, the loan, the amount of money we can borrow on the loan is based on the homeowner's ages. And so again, the younger they are, the less they can borrow. Interest rates is a big one too. If interest rates are higher, that means your loan's going to grow faster. And so FHA reduces how much money we can borrow up front.
And that's really a safety feature. Like you said, you don't want to have the interest rate outpace that growth. Right. So you want to lower how much you can loan. So it's really a safety feature more than anything.
Exactly. And you're probably telling all of your clients the same thing, but the mortgage you're doing right now, just expect it's going to have a short life, because most people are anticipating that rates will be up and down. Inflation could do what it does. But most likely over the next few years, we will see a dip in interest rates, and that's when you'll want to refinance your mortgages, regardless of the kind of mortgage you have. But for our clients, and I have to be careful what I say here because we have so many compliance laws we have to be careful with. Right. But generally speaking, what I'm telling my clients is plan on refinancing this loan a year or 2 or 3 down the road. Because when those interest rates do come down, we're going to want to reset it. We'll do a new appraisal. We'll get your lower interest rate. And because of that lower interest rate, you'll be able to pull out another $20,000 or $30,000, $40,000. And when that happens, we generally will help our clients cover those costs. So you're not getting hit with a ton of fees again. For most of our clients, we're shooting for a zero cost. It's not always something we can do, but that's what we try to do, just to make it a no-brainer. Make the loan better for people, allow them to take advantage of that higher equity they can pull out. But again, I would tell everybody listening to this is just plan on, if you've done a mortgage in the past couple of years, be ready to refi in the next couple of years to lower that rate. And
like I said, regardless if it's a first mortgage or a reverse mortgage or a second mortgage or all that kind of stuff, I think there's a lot of wait and see. There's a lot of anticipation. There's a lot of hedging, and kind of interest rates are baked up a little bit. So we feel that should flush itself out a little bit. And if it doesn't, you're still in a good position because you still got the loan. You still got a better rate than what's available. But if a refinance does come available, that is something you can do with a reverse mortgage or really any mortgage that's out there. So is there like I said, a percentage or kind of a loan to value that you're seeing as kind of a normal for your clients? Like how much are they able to kind of access? And is it different from a purchase or a refinance? Is there higher loan to values with those different programs?
So generally speaking, I tell people about 50%. You want to shoot for about 50%. And again, that's less for older people and it's higher for younger people. Right now with interest rates being as high as they are, it can be as low as 35% is what we can borrow if you're only 62.
And I think that's an important part to think. It really isn't this 80%, 90%, 100% financing type loan for the kids. There's still going to be money left over.
Oh, there's so much left over.
That's the thing I think most people don't realize, or they have this sense, well, I'm just giving the money to the bank or the bank's going to take over the house. If it does get to the point where it gets to that scenario, which is not what they want, nobody wants that. So it's really hard for it to even get to the point where you're upside down. But it is such a low risk, low loan to value that it's worth getting rid of that monthly payment. Yeah. It's worth freeing up that money making your parents a little bit more comfortable and happy with it. I just see this does way more good than negative. And the negative is mostly misconception than true negatives of this loan.
Well, and think about that, because that's a question that comes up for a lot of people as well. What if? Let's play the what if game. If the market crashes and home values go into the toilet, okay, would you rather have a regular mortgage with a required payment where you could lose the home, or would you rather have no required payment? You know what I mean?
Right.
Either way, you're going to lose your value.
Right.
You're going to lose your equity. And so the question becomes, which of the options is giving you more stability if that were to happen?
Right.
So,
And it's such a big if, and it's such a and like you said, the if scenario. What if you are upside down and you pass away? It's not like they're going to go after your kids for what you owe.
Right.
It's already insured. The balance just kind of goes with that particular property. And I would say that of reverse mortgage foreclosures, it's probably the lowest foreclosed loan on the face of the planet for the history of mortgage loans. Like, how many of these actually ever go into either foreclosure or end up upside down? Well, now, maybe a little bit when they first were developed,
sure,
but not anything close in 20 years.
Well, and again, it's funny because when FHA implemented the changes that we have now, the mortgage insurance fund was like $8 billion in the hole. And today we're the complete opposite because these homes are not being foreclosed on anymore. They have a surplus of money because there's no more losses. And so honestly, mostly when we do see foreclosures these days, the reasons for it is because they're not paying their property taxes. It's actually the county that's foreclosing, not the bank.
Not the bank. Okay, yeah.
The other situation would be if somebody vacates the home, they go into a care facility and their kids don't get involved to sell it, they violated the terms of the loan. If they're gone for at least a year, then yes, the bank's got to sell this home because nobody's using it. Nobody's living there. So
that's something else to bring up is like, obviously assisted living is probably a likely situation for versus just going right into passing away for either one of the spouses. Maybe the husband does die more suddenly, but then the wife goes into hospice or some sort of care. You mentioned it's 12 months. So they have 12 months to go into that assisted facility before it triggers the note due or whatever. Right. Once that's triggered, how long do they have to, is it a normal like NOD type process where they have 90 days to reinstate the loan or pay it off or refinance it or something like that? I mean, when does that get triggered when they need to actually pay off the loan?
So it's really when it becomes a permanent situation. Again, if somebody's out of the home and there's no hope of them coming back, it's been triggered, right? So they typically will have about 6 months to sell or refinance, but banks will give them an additional 6 months if they can prove they're trying to sell or refinance. Okay. And so
they're really not. We're not in the business of foreclosure. I'm amazed at how often that's really not what we don't want to foreclose. That's really not what we want to do. We don't want to see those out in the market. We don't want to own the properties when it's all done. It's just the collateral for the loan, and that's what the security is tied to, is the likelihood of getting paid back.
Right.
So foreclosure is bad for everybody in that sense that we're not in the business to do that. It's not like we're like, oh, I can't wait till grandma and grandpa, I can't wait to get their house. I mean, nobody wants that. They don't want it on the news. So I see them more flexible even with reverse mortgages because there's also insurance baked in, and almost 99.9% of the time there is equity the kids are going to get. So they're motivated to either buy it and use it as their own home or just get it sold and split it up with the 4 kids and everybody moves on and collects the money. So it's not something where they're ever really intended for these loans to go back to the bank. They really are going to go to the kids or however it's set up. So how often do you see people, this getting into estate planning a little bit because you're dealing with this a little bit more often, how often are you seeing people put these in trusts or get that paperwork put together? Because on my end, I don't see enough people creating trusts and living wills and those types of things. Really, a trust is what you want to do. How much do you recommend that they get that set up when it comes to this situation?
So generally speaking, I mean, probably about 50% of our clients have a trust.
Really? I would say mine's maybe 10 to 15. It's on the lower end. But I'm also dealing with somebody maybe at the earlier stages, first and second time buyers, not so much the last home generally.
But the funny thing too is that of probably another 40% want a trust and the other 10% just don't know.
Okay.
And so we put out an offer recently this year that for anyone that does a mortgage with us, we'll cover the cost of a trust, because that's usually why people don't do it.
Oh, yeah.
The benefits of a trust are usually good for just about everybody. But for most people, $2,000 or $3,000 to pay for the trust is too much. And so we do have a partner here in town that does trusts very affordably. He actually did my trust. He's very good at what he does. And I think our offer was that through like the end of July, anyone that starts a mortgage with us will cover the cost of the trust for them so that they can have the peace of mind that it's in place.
So how do people get a hold of you? If somebody has questions about reverse mortgage, a phone number, website, how do they get a hold of you?
Yeah, so
Let's maybe put that. Yep, we're going to put your business card on the screen there too. But go ahead. How do they get a hold of you?
So our main number is 435-359-9000. Go to our website at heritagereversemortgage.com. We're very low pressure. So call us, give us your information. We'll give you the options. When it feels good to you, we'll go forward. We're not going to try to twist anyone's arm, and definitely we just want to help people.
That's great. So like I said, I have referred as many clients that I know that need that type of loan. If you need a reverse mortgage or you have questions about reverse mortgage, if you're handling it for your parents or your parents have questions, he's the guy to call. Where are you licensed? Utah, Nevada, or is it just Utah?
No, we're in 10 states. So
10 states. There you go. Okay. Thanks for your time, everyone.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's cleartoclosepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender NMLS number 299717. This has been a production from a podcast studio.